If you're new to Forex trading, you might be feeling overwhelmed by all the terms, acronyms, and strategies. RSI, MACD, pips, lot sizes, and all the rest. But not to worry, you don't need a PhD to start trading Forex. There are 3 essential tools to help you start making sense of the market. These are RSI, moving averages, and candlestick patterns. If you understand these, you'll be ahead of the beginner traders who overcomplicate everything. Let's begin. First, we have RSI. RSI, or Relative Strength Indicator, is your best friend for spotting overbought and oversold conditions in the market. The RSI is a momentum indicator that ranges from 0 to 100 and is used to determine when a currency pair is due for a reversal. Here's how it works. When the RSI is above the 70 level, it indicates that the markets are overbought and could be primed for a reversal. We can see that here a few times on this chart. It does a relatively good job of picking the reversal point. If it's below the 30 level, as we can see here, here, and here, then it's indicating that a bottom may be in place and we might be due for a bullish reversal. The settings on the RSI can be adjusted based on the trading strategy in the instrument, but I tend to stick with the standard settings just to keep it simple. You may notice that the RSI remains above the 70 level or below the 30 level for a period of time. This is indicative of a strong trend. The key here is to understand that when you're using indicators, you're playing probabilities. The indicators are not foolproof. So what matters is when you get the signal or strong enough signals is you manage your risk so that if you lose, you take a small loss. But if you are picking it well and you have a winning trade, then you have a much bigger winning trade. Next, we have moving averages. Moving averages smooth out the price action to help you identify the overall trend of the currency pair. There are 2 types of moving averages that are typically used. Traders will typically use a simple moving average known as an SMA or an exponential moving average known as EMA. The differences in the calculation are not that great, and I use an exponential moving average in my trading. Here's how I use them. I use a 200 period moving average to help me identify the long-term trend. So when the price is trading above the moving average, this means I'm in buy mode. When the price is trading below the moving average, this means I'm in sell mode. You'll notice that sometimes the price chops around the moving average. So if we were getting long or short every time the price moved above or below the moving average, we'd end up getting whipsawed out of our trades. So what I like to do is add a 20 period moving average as well. So when the 20 period moving average is above the 200 period, I'm in buy mode. When it's below, I'm in sell mode. You can see here in this example on gold, that by having the 20 period moving average, it stops us from getting whipsawed during these choppy conditions, but still helps us remain in the trend during trending markets. Moving averages lag the price action since they rely on past data, but they do keep you on the right side of the trend. While I primarily use moving averages to determine the long-term trend, some traders may use moving averages to help determine momentum. If the moving average is steep, then this means that momentum is strong, whereas if the moving average is flat, this means that momentum is weakening. Now, moving averages keep you aligned with trends, helping to avoid bad trades. But how do we find the best entry points? That's where candlestick patterns come in. Candlesticks are a powerful tool for precisely identifying reversals, trend continuation, and key support and resistance levels, all just by analyzing the price action. Candlesticks reflect the battle between buyers and sellers in real time, giving you insight into market sentiment. Imagine the market is moving in an uptrend. Prices are rising, but they don't move in a straight line. There are always pullbacks during the trend. Candlestick patterns will help you identify when these pullbacks are going to happen and the trend is about to resume. I use candlestick patterns every day across timeframes and markets to identify my entry points. And there are 5 primary candlestick patterns that I like to use. Here are several examples of bearish engulfing candlestick patterns that occur during a downtrend. Here's a Morningstar candlestick pattern that's occurred when the RSI is indicating that the markets are oversold. Here's an example of a bullish engulfing candlestick pattern that's occurred after a pullback to the 20 period moving average during an uptrend. Here's a doji indicating that a breakout to a new high during an uptrend might be about to fail. Here's an example of a shooting star that indicates a double top may be in place during an uptrend. And here's an example of a hammer indicating that the strong downtrend may be about to come to an end. Why do these patterns matter? It's because they help you spot high probability setups based on real market behavior, not just indicators. For example, if you see a bullish engulfing pattern off support in an uptrend, that's a strong indication that the trend is about to resume. If the price is in a downtrend and you see a bearish engulfing candlestick pattern off resistance, that's a strong indication that the downtrend is about to resume. Candlestick patterns aren't a guarantee, but they give you a clear edge when combined with other tools like RSI and moving averages. When used correctly, they will help you time your entries with confidence and avoid chasing bad trades. Congrats, you now understand 3 of the most important beginner tools in Forex trading. But there's one more key thing you need to know. That's spread fees, swap fees, and other potential trading costs. Click on the video in the description to learn more about them, and I'll see you in the next one.